Welcome to the deep dive. Today we're really getting into it, looking at a big stack of sources, all centered on ExxonMobil's third quarter 2025 earnings call
Yeah.
and their related SEC filings.
Yeah, and our mission really is to scrutinize this claim they're making. They've said, quite bluntly, that they are operating in a league of our own. It suggests they see themselves as fundamentally different from, the rest of the energy sector.
Different how, though?
Well, that's what we need to test. We need to dig into the data, look closely at their execution, their tech innovations, and this capital strategy they keep highlighting. Does the claim actually hold water?
Okay, let's unpack that then. Before we jump into the details, maybe let's just set the scene financially. Q3 2025 earnings, GAAP, were $7.5 billion.
Solid numbers.
Solid, yeah, but the number they really emphasized, the one they flagged, was earnings per share. They claimed this is their best EPS ever for a similar kind of price environment.
Right, and that's key. It means the story they're telling isn't just, oh, prices were good. It's about structural efficiency, meaning they're showing they can squeeze more value out of each barrel now compared to, say, 5 or 10 years back. Even if market prices are roughly the same, it points to internal improvements.
Got it. And if we're talking proof of execution, well, you have to start with their upstream segment, right? Especially what's happening in Guyana.
Oh, absolutely. Guyana is, it's kind of the poster child for their speed and scale argument. In Q3, production there went past 700,000 barrels a day. That's a new record for the area.
That's 700,000. Wow.
But the real operational story, I think, is Yellowtail, that development.
Yellowtail.
Yeah.
That's the fourth FPSO, right? The floating production unit. And it's the biggest one so far.
It is, designed for 250,000 barrels per day capacity. But it's not just the size. This thing is something like 70% heavier than the previous FPSOs they built.
Heavier. Why?
Mostly because of the increased capacity and, importantly, necessary upgrades for greenhouse gas performance. But here's the kicker. They brought it online 4 months ahead of schedule.
4 months early.
Yeah.
On something that complex. That sounds almost too good to be true in this industry, doesn't it? Was the original schedule maybe a bit padded?
That's a fair question, but, looking at third-party analysis, like from Wood Mackenzie comparing similar mega projects, this does seem genuinely impressive.
Okay.
Bringing something of that scale online early, coordinating across continents, safety standards, it strongly suggests they've really industrialized their development process. Like, they're not building one-offs anymore.
More like a production line for giant ships.
Something like that, yeah. Standardized designs, smoother supply chains. It's an advantage.
And they're not stopping. They just sanctioned Hammerhead, the 7th development there. That starts up in 2029, they say. It's just relentless.
It is. And we should also mention the local impact. It's crucial for their social license. The reports say Guyanese nationals now make up over 2/3 of the oil and gas workforce there.
That's over 6,000 people.
Yeah, over 6,000 local jobs. So it's investment in people, not just steel.
Right, right. And that theme of scale and execution, it carries over to the Permian Basin, too, back here in the U.S. Another production record there. Almost 1.7 million oil equivalent barrels per day.
And their Permian strategy is really interesting because it's where they explicitly contrast themselves with competitors. They expand them organically, sure, but also through these targeted acquisitions.
Like the recent Cinnacon Petroleum deal, buying that acreage in the Midland Basin.
Exactly. Over 80,000 net acres, high-quality stuff.
So what makes their acquisition strategy different? I mean, lots of companies are buying up Permian land.
It connects to the bigger picture, this idea of 1 + 1 = 3. When they buy acreage, they're not just buying oil in the ground. They're buying places to deploy their specific tech, their drilling patterns, their water management.
So it's about applying their system. An acre that might give, say, an 8% return for someone else could give them 15% because they can plug it into their machine.
That's the idea, turning good assets into high-efficiency assets through their methods. And they made a point of saying this sets them apart from rivals who are talking about cutting investment, hitting peak production, or shifting into harvest mode.
Harvest mode. That usually means a company thinks the best growth is done or it's too expensive to keep drilling aggressively, right? Focus on cash flow now.
Precisely. They're essentially saying, we're not doing that. By doubling down on Permian growth for the next decade, they're positioning themselves to fill the gap others might leave and meet that, projected long-term oil demand.
Which leads us right into the technology piece, because that's what enables the efficiency you're talking about. Let's get into the tech in the Permian. That lightweight proppant sounds really interesting.
It really is, and it's a great example of integration. So just for context, proppant is usually sand or maybe tiny ceramic beads, right? You pump it down during fracking to prop open the cracks so oil and gas can flow.
Standard procedure.
Hmm.
But theirs is different.
Yeah, it's proprietary, patented, it's lightweight, and here's the clever part. It's made using low-cost refinery coke.
Refinery coke from their own refineries.
Exactly. So first, that gives them a built-in, low-cost supply chain linking upstream and downstream. Hard for others to copy if they don't have that refining capacity. Second, being lighter means it travels further into the fractures.
Reaching parts heavier stuff can't.
Right. And the result, they claim, is up to a 20% increase in well recovery.
20%.
Yeah.
That's huge. That's not tweaking, that's a step change. And Wood Mackenzie backed this up.
They did. They specifically noted that the integration, using their own refinery output, creates a strategic advantage that's, well, difficult to replicate.
And they're rolling this out fast.
It seems like it. They said about a quarter of their Permian wells this year, ramping up to roughly half of new wells by the end of 2026. So yeah, it's moving from R&D to large-scale deployment.
Okay, so that's downhole tech, but they also talked about computing power. Discovery 6, this new supercomputer.
Yeah, developed with HPE and NVIDIA, apparently the 17th most powerful computer in the world, which is, quite something.
But what does a supercomputer actually do for an oil company? Faster emails.
Well, maybe. But mainly it's about speed in decision-making. Things like seismic processing, mapping the geology underground, that used to take months.
And now?
Now it takes weeks.
Okay, faster is better, but how does that translate into the $1 billion in value capture they mentioned? That seemed like a big leap.
Good question. The value, they explained, is tied to optimizing resource recovery, specifically from those first 6 FPSOs in Guyana. Faster processing means they can model how the oil and gas is flowing in the reservoir much more quickly and accurately.
So they can adjust production faster.
Exactly. Understand the reservoir, tweak things like where to inject water, optimize well placement, basically make smarter, faster decisions to get more oil out that might otherwise have been left behind. So faster computing leads to higher recovery factors, which equals real money.
Bites to barrels, then. Makes sense. Okay, let's shift gears a bit. Beyond oil and gas, they're pushing into new ventures. Proxima Systems. They mentioned tripling production capacity this year.
Yeah, Proxima is interesting. It's about leveraging their core strength in, molecular engineering and material science to create new high-value products. Not fuels, but advanced materials.
They gave that example with construction rebar, didn't they?
Yeah.
Proxima-based rebar being 40% faster to install than steel.
Right. And they're targeting, 20,000 tons of sales by 2027? So scaling up.
And the marine coating, too. A one-coat system cutting application time in half for cargo tanks. That must save ship owners a lot of time and money in dry dock.
Definitely. And they're using it themselves, planning to use Proxima for subsea installation on their own Hammerhead FPSO in 2026. That's a good way to prove it works. Use it yourself.
Eating their own cooking, so to speak.
Exactly. But maybe the biggest bet on the future, the one really looking beyond hydrocarbons, is batteries, the battery supply chain.
Ah, yes, the acquisition of assets from Superior Graphite. That seems significant.
Very strategic. They're aiming to develop and scale up a new way to make graphite for battery anodes. The key is they think their process can be 50% more energy efficient and much lower cost than what's out there now.
And they explicitly mentioned aiming to outcompete the Chinese suppliers who dominate that market currently.
They did. It's a direct challenge. And the performance claims from early tests are, frankly, pretty startling.
Would they say faster charging?
30% faster charging, yes. And a 30% boost in effective range for EVs. But the really big one, I thought, was lifespan lasting up to 4 times longer.
4 times. That completely changes the economics, doesn't it?
Mm-hmm.
Especially for grid storage or industrial use.
Absolutely. It moves it from a consumer product lifespan to potentially an industrial one. That creates a premium product opportunity, especially if they can offer a secure, non-Chinese supply chain. They estimate the total market they're targeting could be up to $40 billion.
$40 billion. Okay, so this isn't a side project. It's serious.
Seems that way. It's a major pillar for long-term growth.
Okay, let's pull back to the present and the final piece of this League of Our Own puzzle. Capital discipline. They hammered this point home. Those cost savings.
Massive. Over $14 billion in structural savings since 2019, cumulatively, and $2.2 billion just in the first 9 months of this year, 2025.
That kind of efficiency, it has to lower their break-even costs significantly, right? Makes them more resilient.
Definitely. And they claim that level of saving is well ahead of competitors. It's foundational to everything else.
And then looking at spending, their 2025 cash CapEx guidance, not counting M&A, is expected to be slightly below the bottom end of their $27 to $29 billion range.
Right. Which might seem odd if they're in full growth mode. Why underspend?
Exactly. What was the reason?
This is what they call disciplined pacing. They said the slight reduction is specifically about slowing down investment in some of the newer ventures, especially the low-carbon solutions portfolio.
Slowing down low carbon. Why?
Because, and I'm quoting here, the associated markets are not developing as fast as we had planned for.
Ah, okay. So it's not that they don't have the money. It's that they don't see the immediate market demand to justify spending it right now on those specific projects.
That seems to be the message. Wait for the market pull, don't push capital out ahead of it, maximize efficiency. It's a sign of scrutiny on returns.
And we should probably remind ourselves that $2.4 billion they spent on acquisitions in Q3 Superior Graphite, the Silicon land that's separate. That's outside the main CapEx budget range.
Correct. And alongside that discipline, the shareholder returns continue. $9.4 billion returned in Q3 alone.
Wow. How did that break down?
$4.2 billion in dividends, $5.1 billion in share buybacks. And, they have that incredible track record, 43 straight years of growing the dividend annually.
43 years. That's consistency. Mm-hmm. And finally, on the governance side, they introduced something interesting for retail shareholders, an opt-in voting program.
Yeah, first of its kind, apparently, approved by the SEC. It's trying to tackle low voter turnout among individual investors. Retail owns almost 40% of the company, but only about a quarter of them typically vote.
So this program makes it easier.
It lets them opt in for free to have their shares voted automatically according to the board's recommendations. The idea is just to get more of those shares actually participating in governance votes.
Interesting approach. Okay, so let's try and tie this all together. Does the evidence support the claim? Are they really in a league of our own?
Well, based on this quarter's data and commentary, their strategy certainly looks differentiated and arguably quite effective right now. You've got these two main thrusts, right?
Go on.
First, just world-class execution in the core business. Scaling up production where they have a clear advantage, Guyana, the Permian driven by speed and technology, getting those FPSOs online early, rolling out that proppant.
Okay, execution focus. And second,
this aggressive development of new, potentially high-return products in adjacent or future markets. Things like the battery components, Proxima materials, leveraging their science R&D into new areas.
And this is all based on their view of the future, their long-term outlook.
Exactly. They see continued strong demand for energy through 2050. They forecast about 5% oil growth, 20% gas growth, LNG demand doubling over 25 years. So they're building the efficiency and the tech to capture a large, profitable slice of that ongoing demand.
Betting that reliable, cost-effective energy will always be needed, basically.
That seems to be the core bet, yeah.
Okay, so here's a final thought, something for you, the listener, to maybe chew on. They mentioned in the filings that the energy industry faces this huge challenge, high depletion rates, especially in places like the Permian. You need constant, massive investment just to keep production flat.
Just to stand still, essentially.
Right. So given ExxonMobil's huge cost savings, over $14 billion since 2019, and these tech advantages like the proppant giving maybe 20% more oil, the question is, how crucial are that kind of structural efficiency and unique technology, not just to fight depletion, but to actually enable sustained growth year after year through all the ups and downs of commodity prices?
That's a great question. How much of an edge does that truly provide long-term against geology itself?
Something to think about. That's your deep dive homework. Thanks for joining us.
We'll catch you on the next one.